I am going to give an example about how the net asset value of a bond mutual fund changes with yield changes in the underlying bonds. This module will relate directly to the Wall Street Journal article that I handed out in class and is part of this homework. That article was entitled Long-Term Treasuries Had a Winning Quarter, and it told or described how extended duration Treasury index funds did well during the third quarter of 2015. And one of the main reasons why they did well was because of yield decreases during that quarter. As a review, here's what a mutual fund does. It holds assets, stocks, bonds, money markets. In this case, we're talking about bond mutual funds. So the funds hold bonds. Fund management determines how many of those bonds to hold, and then the investor holds shares in the bond mutual fund. So the investors do not own the bonds directly, but they own net or stocks in the bond mutual fund. The value of each stock in that mutual fund is determined and it equals the net asset value. You see the formula for calculating the net asset value there. It's the market value of the underlying assets in the mutual fund minus any liabilities that exist divided by the number of shares of that mutual fund. As an example, here's a mutual fund with 10 million shares. It has a $215 million market valuation. What that means is they add up the values of each of the stocks or bonds in that mutual fund and it comes to $215 million. There's $15 million of liability. The net asset value for that share on that bond fund, given these parameters, is $20. That net asset value will change from day to day as the underlying value of the stocks in or the bonds in the mutual funds change. So if bond prices go up, the net asset value will goes up, and similarly if the bond prices go down, it will go down. So at the end of the day, if bond prices have gone up and you decide as an investor have a share in that mutual fund, you decide to redeem that one share, it will be worth more if bond prices go up. And conversely, if bond prices go down, it will be worth less and you will redeem less. Straight how bond yield changes will impact net asset values. I have in front of you a spreadsheet called Bond Fund Change. It's also available attached to this module so you can download it. There are a couple elements to it that I'm now going to describe. First, we have yields on treasuries from Treasury Direct. This is the same site in which that you're downloading data for your asset tracking exercise. I have here bond yields from January or July 1, 2015 up to September 30th, 2015. So we have data for the complete period, third quarter. And these are all they're all the bond funds in the Treasury Direct, 1 month, 2 month, 6 month. We are going to focus here on the 5-year and 10-year notes. Over to the right, this also includes a way of calculating a bond price for a 5-year Treasury, given $1,000 par. You can put in a coupon rate, yield to maturity, and this just follows the homework that we've done before. We calculate the cash flows. This is a 5-year Treasury, so there will be 20 semi-annual periods. We have the cash flow for each period. You can follow the formulas, discount factor, discounted cash flow, sum those up and we get the bond price, which I've also put here. Do the same thing over here for a 10-year Treasury. Same basic setup, $1,000 par. You can put a coupon rate, which determines the cash flows, yield to maturity. We also calculate a bond price. Since this is a 10-year treasury, there will be 40 periods. Here is the sum of those discounted cash flows, which then gives us the bond price. What I'm going to do is come over here and we are going to focus on the 5-year and 10-year notes. Those would be extended duration. And for each one of those, I am going to pull down the beginning and ending date for that quarter. We're going to put the yields for the 5-year right here. We're going to do a yield and a price, and this will be the price of a bond fund. This will be for a 5-year. And let's pull down the price for, or the yield for July 1.7 yield. We have 1.37 at the end. So this bond decreased in yield. You can graph that. And you can see here it went down over that quarter. So from 1.7 to 1.37. So the price of a 1.7 yield bond we can calculate over here and have done already. It's $970. Put that right there. And now we will do the same thing with 0.0137. That bond has a price of $1,047. So there's our two prices. Beginning of the quarter, it was worth $970. End of the quarter, $1,000. Yields went down, price of the bond went up. Bond price went up because we have a lower yield, and if we held this bond in that mutual fund, it would have contributed net asset value of would have contributed $970 to the net asset value at the beginning of the quarter, $1,047 at the end of the quarter. Let me do this for the 10-year note. We're going to get both the yield and the price here for the 10-year note. And what I'm doing here with the 10-year note is just comparing, these are both fairly long duration bonds, but one is obviously longer. The 10-year note is longer duration than the 5-year note. Again, 10-year notes went down from 2.43 to 2.06. We come over here, 2.043. That bond had a price of $932.21. So, end of the or beginning of the quarter, 932, 2.06 at the end, 990. And again, bond price increased over that quarter. Now, we can calculate, so this, if we held this, would be a capital gain. Let's calculate the percent capital gain during the quarter. It would have been 0.01 or 0.03%. That is on a quarterly basis. Let's put it on an annual basis. Annualize the capital gain. So we're going to annualize that capital gain. Oops. We'll use our formula for annualizing gains. We raised it to 4. There's 4 quarters in the year. So here, 13% return for that asset. I mean, capital gain for that bond, 13%. The 10-year note, all right, think about this before I do it. Would it be higher or lower? And it's most likely going to be higher because it's a longer duration, and in fact it is, 27%. All right, so if we look at those two, what we see is if we held these bonds and just these bonds would have contributed 13.1% gain to the mutual fund. This bond would have contributed 27.3%. Again, yields went down, prices went up. So to summarize here, bond mutual funds will have capital gains or losses depending on what's happening to yields. Treasury bonds, it will be totally due to yield changes. Other items, corporate bonds where there's default risk will also enter into the calculation or the impact on yields and therefore the impact on prices. If we have yield decreases, bond funds will have capital gains and they'll usually be larger for longer duration bonds. So bond funds that have extended duration or have longer durations will tend to have larger changes when yields decrease. On the other hand, when yields increase, bond funds will have capital losses and they're usually larger for longer duration bonds. So, the risk associated with capital gains or losses on bond funds are usually larger for longer duration bonds. As those bonds increase, yields will have larger impacts. Hopefully, this will help you as you answer the questions associated with that Wall Street Journal article that you have to answer for this homework.